were few, but I'm sure the ideas and discussions will be rich, inshallah. This session title is Fed Spillover Effects, Exchange Rates, Monetary Policy, and Informality, to reflect the themes discussed by the three papers. We'll start by what was supposed to be the second one, pricing behavior and exchange rate, evidence from Iran consumer prices, by Hamidreza, Aziminia, Seyed Ali, and Amineh Mahmoudzadeh. I think each presenter is expected to speak for 15 minutes. If you save some few minutes, you will have a bonus by having light discussion. So please keep an eye on the time. Should we have the discussion of each paper separately? Okay. So let's start with this. Go ahead, our colleague online. Who will be presenting this? Hamidreza? Okay. Please go ahead.
Thank you. Hello, everyone. I'm glad to present this paper at the ERF conference. This paper is part of my PhD dissertation, which is supervised by my co-authors, Seyed Ali Madanizadeh and Amineh Mahmoudzadeh. In this paper, we present evidence on the effect of exchange rate shocks, FX shocks, on pricing behavior using novel consumer price codes from Iran. I think maybe a lag in presentation, and you will see the next page. Why does pricing behavior matters? Pricing behavior is one of the ways that firms react to shocks. When studying the effect of aggregate shocks, it's crucial to consider the response of economic agents. This graph from the famous paper by Golosov and Lucas, JPE 2007, shows how two economies react to the same shock. The only difference between these economies is in their pricing decision rule. The solid lines represent economies using the menu cost model, a state-dependent pricing model, while the dashed line represent economies using Calvo pricing model, a time-dependent model. We observe that in menu cost model, the effect of shocks disappears sooner than in Calvo model. In other words, the pass-through of the shock in Calvo model is longer compared to the menu cost model. This simulation shows how price setting decisions significantly impacts the response to shock. Therefore, to analyze the effect of shock, we must first understand the pricing behavior of firms and outlets. Why do we focus on the exchange rate as a nominal shock? A menu cost model has a theoretical prediction. After aggregate shock, markup is changed, and the firm responds by adjusting its price to offset the effect of shock on markup. But there are some questions. Can we observe this prediction in real world? How do we measure the response of prices to these shocks? Empirical studies in macroeconomics show that CPI inflation impacts pricing behavior, and this fact confirmed the menu cost model prediction. These empirical papers use inflation as a proxy for aggregate shock, which send a signal to firm to adjust their markup and prices. However, the information content of macroeconomic condition is not limited to inflation. Other variables like exchange rate can provide complementary information that firms use in their price setting decision. The experience of Iran in past 20 years with different inflationary periods and exchange rate fluctuations provide a suitable environment to find evidence for these topics. Building on these previous explanations about the importance of pricing behavior and the role of FX shock, our research question is, what is the effect of exchange rate shock on pricing behavior? In this study, like other studies in this literature, we focus on two aspects of pricing behavior: frequency of price change and absolute size of price change. These are the main variables that help describe how firms adjust their prices in response to shock. We also look at how exchange rate shock affect pricing behavior by which two main channels: the cost shock channel and expectation inflation channel. While previous studies have looked at this channel separately, our paper combines both to give a more complete picture of how FX shocks influence pricing decision. Now, let's move to the data set used in this paper. We use consumer price codes from the Statistical Center of Iran, SCI, for the period from 2006 to 2022. SCI collects monthly retail prices from urban areas to calculate inflation, and our sample covers all the collected data excluding rent, similar to other studies in this literature. Our sample includes 453 products across 31 provinces, and each product represents a specific item in household consumption basket. For example, we can refer to items like seedless scraps, woman's jacket, construction worker, 1 hour of geometry teaching, and other. There are a variety of different products that consumed by household. Totally, our sample covers 37 million price codes over 16 years in our sample. Using this data set, we follow previous studies in this literature to construct indices that measure the frequency of price change and absolute size of price change. Our indices are calculated at the product month level. The index for the frequency of price change measures the share of prices that change for a specific product in a specific month. For example, if the frequency for woman's jacket is 20% in a specific month, it means that 20% of woman's jacket prices are changed compared previous month. Our index for absolute size of price change measures the average percentage of price change conditional on price change occurring. Now, let's take a look at the summary statistics from the dataset. In our dataset, the frequency of price change has a mean of 23%. It means that in each month, on average, 23% of prices are changed compared to the previous month. For the absolute size of price change, we observe a mean of 14%. That shows the conditional mean of price change. Absolute size of price change in each month is 14%. Change, both CPI inflation and FX depreciation have a mean of approximately 23%. But the variation of FX depreciation in our dataset is much wider. Now, let's review the empirical strategy used in this paper. Many other empirical studies in this literature, such as Nakamura, Stensen, Alvarez et al., and others, present empirical evidence using simple statistics and scatter plots to show the effect of inflation on pricing behavior. In this paper, we try to examine the effect of multiple variables on pricing behavior. Then we cannot rely on simple statistic. Instead, we use OLS regression to find the impacts of inflation, FX depreciation, and expected inflation on pricing behavior. The main specific is shown here. Y sub-IT represents the frequency or absolute size of price change for product I at time t, and it is the dependent variable. On the right-hand side, we include pi sub t, the monthly inflation, delta E sub t, the monthly FX depreciation, the interaction term between inflation and FX depreciation, and pi sub t to the power of E, the expected inflation at time t. We use the expected inflation index from Alvarez et al. 2019. This regression is run at the product time level, allowing us to include product fixed effect as control variables. Additionally, in complementary specifications, we include the S-squared form of inflation and FX depreciation as control variables to capture their nonlinearity effects. Let's go to take a look at the standardized result. In this table, the coefficient show how much one standard deviation increase in each variable affects the frequency of price change. First, we confirm what other studies have found about the positive effect of inflation on frequency of price change, as you can see in the first row of 3 columns. But our findings are more than confirming earlier studies. In column 1, the baseline model, the coefficient for FX depreciation is not positive, but the interaction term between inflation and FX depreciation is positively significant. It means that when inflation is high, FX shock lead to more price change, and the effect of exchange rate depends on inflation level. In column 2, we focus on the nonlinear effect of inflation and FX depreciation. In this case, the interaction term is insignificant, but S-squared term for FX depreciation is positive and significant. Interestingly, the S-squared term for inflation and the linear form of FX depreciation are not positively significant. This suggests that inflation's effect is linear and doesn't depend on the level of inflation, but the effect of exchange rate depreciation depends on the level of FX growth and only shows up when the appreciation is high. In column 3, we replace the monthly variables, monthly inflation, monthly FX depreciation, with 12-month inflation, 12-month FX depreciation, 12-month expected inflation. This allows us to look at the long-term effect of inflation and FX depreciation as opposite to short-term fluctuation. In this column, unlike in column 1, the coefficient for FX depreciation is significant, and its effect in magnitude is near inflation coefficient. This shows that the long-term effect of FX depreciation is actually stronger than its short-term effect. Finally, it's interesting to note that the coefficient for expected inflation is strongly significant in all 3 models. This shows the importance of expected inflation in shaping the price decision rule. This slide shows the standardized result for absolute size of price change, and due to limited time, I will only mention the main result. In column 1 and 2, we don't observe evidence that exchange rate depreciation affect the absolute size of price change, either linearly or non-linearly. However, in column 3, using 12-month variable, we observe a positive and significant effect, suggest a long-term impact of FX depreciation on absolute size of price change. We also conduct several robustness evidence that confirm the consistency of our result. I will skip the detail here, but I would be happy to return to them during the Q&A. To conclude, let's summarize the finding and implication. We find three key findings about the effect of exchange rate depreciation on pricing behavior. One, we find that the effect of FX depreciation is weaker in short term, but becomes stronger over the long term. Two, we also observe a positive effect for the interaction term between inflation and FX depreciation that shows FX depreciation has positive effect when inflation is high. But this effect is significant only for the frequency of price change. Three, we find a nonlinear effect of FX shock, which shows a significant effect in episode of large depreciation, and again, this effect is observed only in the frequency of price change. Exchange rate depreciation can affect pricing behavior by two channels, cost shock or expected inflation, expected inflation. We find that the coefficient for FX depreciation is significant, even when expected inflation is under control. This shows that the effect of exchange rate shock is not limited to rising expected inflation, and cost shock plays a role in FX shock. Now, what are the policy implications of our finding? We find that large depreciation significantly increases the frequency of price change and decreases price rigidity. As a result, the real effect of monetary policy in this period is likely to be smaller. Accordingly, we show evidence for a new mechanism that reduces the real effect of traditional monetary policy tools. Additionally, our findings also have implications for the development of menu cost models. Current models typically consider one common shock and one idiosyncratic shock. But by Alvarez et al. 2019, we know that in times of large inflation and devaluation, the importance of idiosyncratic shocks will be small, and a menu cost model that captures multiple common shocks might offer a more accurate and useful framework to analyze the inflationary periods. Thank you for your attention.
Thank you very much, Hamid. And now we turn to our discussant, Dr. Heba Atef Emam. She's an associate professor in Faculty of Economics and Political Science, Cairo University, and an advisor at the Central Bank of Egypt. And I'm looking forward to hearing your opinion about this interesting topic. I would like you to confirm whether this paper encourages or recommends to have a gradual foreign exchange regime, the changes to be gradual rather than the large shocks. This is better for the economy and monetary policy management, or this is not considered as one of the policy implications. Thank you.
Thank you, Dr. Sherine. It's definitely my pleasure to be co-discussing the session with you, my dearest doctor. Okay, so and I'd like to thank the author for his effort in carrying out the paper. It's obvious that a huge effort has been carried out, especially in the econometric part. Okay, so basically the paper tried to investigate the impact of FX fluctuations on pricing behavior using a comprehensive micro data set of Iran CPI from 2006 to 2022. It actually tried to provide empirical evidence on how the FX growth affect pricing behavior. the paper has a lot of strengths point. The topic is interesting. It has potential policy implications for emerging markets. There has been a significant effort done in carrying out the empirical work, and the paper is really well written with logical flows of idea. However, moving to the comments, on the organizational side, the paper is actually too long. It's around 54 pages, which is too long for a working paper. Maybe for a working paper you wanted to elaborate in details the econometric work and to explain each part, especially that a lot of models have been estimated. But I believe for the sake of publication, you will need to summarize it a lot. Moreover, I believe there are some analytical comments that need to be tackled by the paper. You mentioned in the paper that the primary contribution of the paper is its evidence on the effect of FX shock on pricing behavior, offering valuable insight for extending menu cost models to account for unstable environment. However, what actually happened in the paper was that you accounted for FX as one of the variables. You just take the value of FX growth and you incorporated it in the model without accounting for FX shocks. If you would like to identify shocks, you need to identify for the model some periods that represent FX shocks, and you have to see whether these shocks have significant effect on the pricing behavior or not, rather than just putting all the time series. Especially that you already mentioned the descriptive part, that there are some periods of shocks in Iran that you have identified already. Also, you mentioned in the paper that the study will focus on 3 macroeconomic environments: inflationary periods that characterized with sharp FX jumps, inflationary periods with stable FX, and periods of low inflation. Again, what the model did was that you just incorporated the series of the FX and series of inflation and the interaction term for both of them. So it was not identified whether this period is an inflationary period with FX jumps or not, or whether this period is of a low inflation. So the coefficient that you got from the FX and inflation interaction term is just an average of all the data incorporated in the model. You should have identified each period, like for example using a dummy variable or whatever, so that you can significantly mention how each of these periods affect the pricing behavior of firms. Again, you mentioned in a separate section about the descriptive part in Iran and the institutional arrangement and how unstable macro environment took place in different periods in Iran. However, this was not accounted for in the model. Moreover, even though there was a section on the Iranian case and there have been a lot of models estimated, the paper did not link the findings to the Iranian case, nor it even tried to derive policy implications for Iran or for the emerging markets. I know you overcome some of these comments in the presentation, but in the working paper itself, this was not available. As for the model itself, I was wondering why you mentioned that one of the methods used for expecting inflation is that you take the USD movement in the unofficial FX market across all periods. So why don't we take the official FX market during normal periods? Maybe during crisis time, you can take the unofficial FX market. Like during normal times, we usually rely on official FX market. Or is this something specific to the Iranian case? Also, while estimating the panel data model, you, based on the literature, decided to estimate a fixed effect model. But actually, when it comes to estimation, we have to go back to the necessary test, which is Hausman specification test, to decide whether the underlying data suits fixed effect or a random effect model. In the model itself, I have some doubt of adding 2 variables that are very much correlated. You had actual inflation and you had expected inflation that is derived from actual inflation. So we have you use different proxies for expected inflation, but still the 3 more or less depends on the actual inflation figure. So there are 2 independent variables that are highly correlated, which will definitely affect the findings of the model. Also, even the FX growth variable, it depends on actual inflation. So I doubt that there is a huge degree of multicollinearity between the variables incorporated in the model. In equation 7 and 8, when you had the contribution of estimating the province level regression, you had inflation, actual inflation, on the country level and on the province level. And you have FX growth on the country level and province level, though your Y was the pricing behavior on the province level. So I think the four variables are highly correlated, because at the end, inflation, the country level inflation will be derived from province level inflation, and same for FX growth. And since your Y is just on the province level, so why are you incorporating the inflation and FX of the country level? And that's it for my comments. Thank you. Sorry, I just want to add something. Can I add one more thing? Okay, just one last thing. When you try to estimate the short run versus long run model, you just use a different set of data. And you used monthly data for short run and then lower frequency data for the long run. Usually when we do this, we estimate a panel, for example, ARDL model, that already you just do estimation once, and the results will give you the difference between short run and long run. Because when you use different set of data, there might be some differences in the collection of data or whatever, so you cannot compare the results, and you just say that this is applies in the short run and this is in the long run. Thank you.
Thank you, wallahi. And this is my first time. I have been working with this quantitative tools, but this is my first time to see mixing monthly data with annual data in one model, in the calculations.
Two separate models.
Two separate, okay.
For the short run, you use monthly data.
But as you said, we have Ardel that can distinguish between the two. And even the error correction model, Bordeaux, it can distinguish between the two. Thank you very much for this. Do you want us to go back to the author? No. So we move to the next one, which is what was supposed to be the first paper, monetary policy spillover effects of the Fed and the ECB, evidence from Turkey by Yasemin Yalta and Talha Yalta. So, please.
Good afternoon. Today I will present our joint paper on monetary spillover effects of the Fed and ECB, evidence from Turkiye. I will first briefly explain our motivation, theory, literature, then discuss our methodology, empirical findings, and conclude with policy implications. We know that following 2008-2009 financial crisis, major central banks implemented unconventional monetary policies. Therefore, a huge literature arose examining the effect of these policies. And actually, existing literature highlights that these policies have significant effects on various financial variables and macroeconomic variables in many countries, including emerging countries. But of course, it is also important to distinguish between different dimensions of monetary policy. Most of the literature focuses on either conventional or unconventional policies, but it is important to make a distinction between interest rate changes, forward guidance policies, and long-term asset purchases. However, much of the literature still tends to focus on only one dimension. Also, most of the literature focuses on the effect of Fed's monetary policies, ignoring the role of ECB or providing a comparative analysis on the subject. So in this paper, we try to distinguish between three dimensions of monetary policy, and we will do this for both Fed and ECB. To see if these spillover effects are different for Turkey, because Turkey is closely related with the United States and European Union countries through financial and trade linkages. Although United States dollar is the reserve currency and financial integration is higher with United States, almost half of our trade relations are with European Union countries. Therefore, we also have trade linkages, and we want to see which central bank's decision is more influential on Turkey. When we go over the literature, we see that most studies focus on one dimension. And also while spillover effects are documented, we see that they focus on Fed effects, or either they examine global spillovers using global VR analysis. As you see, there is a very large literature on Fed policy spillovers. For ECB, there are a few papers, but these papers mostly focus on European Union countries or non-Euro European countries. There are also some comparative studies undertaken in recent years, and especially after 2021, there is a new literature trying to decompose different dimensions of monetary policy. But there are only few papers. None of these are on emerging market economies. They consider global implications. When we go over Turkey-specific literature, we see that most of the studies focus on interest rate decisions. There are some studies also examining the role of unconventional policies, but these studies do not consider several dimensions. They don't compare Fed and ECB effects. They focus on Fed's monetary policy effects. Therefore, we attempt to contribute to the literature in this sense and to see which banks' policies affect Turkey the most. We know that conventional and unconventional monetary policies work through different transmission channels. For conventional policies, we know that interest rate channel, exchange rate channel, credit channel, and trade channel are the most important ones. But for unconventional policies, we know that portfolio rebalancing channel, signaling channel, risk-taking channel play an important role. And also, conventional and unconventional policies differ in terms of magnitude and duration. For example, conventional monetary policies have immediate effects, whereas unconventional monetary policies have prolonged effects through mechanisms like quantitative easing and forward guidance. As an empirical method, we are going to use a Bayesian VAR approach, VR approach. This approach allows for a robust analysis of dynamic interactions between variables, and this approach also helps us handle small data set for Turkey. Our primary variable is, of course, different dimensions of monetary policy, changes in target rate, forward guidance or patch shocks, quantitative easing or long-term asset purchases. We obtained this data from Miranda Agrippino and Nenova data set, which was recently developed by these authors, by using high-frequency distributions around Federal Reserve's monetary policy announcements. Therefore, these are three dimensions: target policy rate shocks, forward guidance or patch shocks, quantitative easing or asset purchases. We want to examine the effect of these monetary policies on treasury bonds, exchange rates, inflation, and industrial production in Turkey. Now I will show a set of impulse-response functions. We want to examine the effect of Fed's and ECB's policies separately for three monetary policy dimensions. So we will have 6 impulse-response graphs. The first one analyzes the effect of target shock in the United States in Turkey. We see that in terms of long-term bonds, there is a positive relation as expected. Again, as expected, exchange rate depreciates after a tight monetary policy. In terms of industrial production, we see a decrease. And in terms of inflation, at first we don't see a significant reaction. This is the effect of one standard deviation shock in forward guidance by Federal Reserve. Again, similar to the first one, we see that there is a positive response by long-term bills. Exchange rate also depreciates. This time we see that depreciation is a little larger. Industrial production shows a decline after the second month. This is again expected because we expect a prolonged effect, not an immediate effect. In terms of inflation, again, we don't see a positive effect immediately. We see just a delayed moderate increase in later periods. This is the effect of one standard deviation shocking quantitative easing by Federal Reserve. Again, in terms of treasury bills, we see a slight positive response. For exchange rate, again, there is depreciation, but we see that it's a little smaller than the previous shock. In terms of the effect on industrial production, we see that there is a delayed response. And in terms of inflation, we see that there is a decrease between second and fourth months. Now we turn to the effects of ECB's policies. The first set of impulse response functions show the effect of a target shock by ECB. This time we see a negative response of treasury bonds. In terms of exchange rate, we don't have a significant effect. In terms of industrial production, we see that there is a negative effect between second and fourth months. This effect is expected because this tight monetary policy will lead to a slowdown in the economy. Especially when European Union countries adopt a tight policy and when demand slows down in those countries, it means that Turkey's trade will also be negatively affected. And also we see that inflation responds negatively after the second month related with this slowdown. This impulse response function shows the response of the same variables in response to a forward guidance shock by ECB. In terms of the effects for the target shocks, they are similar. We see that treasury bills respond negatively. Normally we would expect a positive effect, but maybe the demand for Turkish bonds might be increasing due to the counter-cyclicality. In terms of exchange rate, we see that the effect becomes significant after the second month. Industrial production responds positively after the fourth month, but it's a very small response. Otherwise, it responds negatively as an immediate effect. Consumer price index shows a negative effect at first, but then we see that it becomes negative after the second month. And actually, when we look at all these impulse response functions, we see usually that for treasury bills, for exchange rates, the effects are not persistent. There is always a delayed response. In terms of quantitative easing shocks by ECB, we again see similar results. Treasury bonds respond negatively. Exchange rate doesn't respond significantly to ECB shocks. Yes, okay, thank you. This might be related with the fact that Turkish economy is more closely linked with United States rather than ECB because we don't see significant effects here. And again, in terms of inflation, we saw only a weak response to ECB shocks. Similar to industrial production, we have weak responses. Finally, what do we conclude? We conclude that Turkish economy is affected from both Fed's and ECB's policies, but when we compare them, we see that Fed's policies are more influential because of close ties between countries. Actually, this is in line with the literature. Most of the literature comparing the effects of Fed and ECB concluded the same thing. Fed's policies are always more effective. So what do we conclude? We say that monitoring global developments is important for central banks so that they can implement preemptive measures. We see that Turkish exchange rates are affected by Fed's policies. Therefore, it is important for central bank to manage exchange rate volatility. Inflation is also affected by these policies, so inflation management should be one of the priorities in Turkey. And of course, as usual, giving importance to structural reforms and domestic production should be key policies so that we won't be negatively affected by these monetary developments around us. So in the future, we can extend this analysis for other emerging market economies. We can explore nonlinear effects of these policy shocks in the context of different time periods, for example, during financial crisis or periods of high volatility. Thank you. Oh, okay.
Thank you. Now the floor is yours.
Thank you. Thank you, Dr. Sherine. Actually, I would like to thank you, Yasemin, for the topic. It's very, very interesting and very important, especially given the fact that lately most of advanced countries have been using unconventional monetary policy. So the impact or the spillovers of conventional versus unconventional on emerging markets have been one of the very, very up-to-date topics in monetary policy. So basically, the study tried to examine the spillover effect of both the Fed and the ECB monetary policies on Turkey. See how various monetary policy dimensions, like interest rate changes, forward guidance, and QE affect various macro and financial variables in Turkey. And the Bayesian VAR model has been employed. So as I mentioned, the topic is interesting and it has a valuable contribution to literature. Advanced techniques have been used in empirical analysis, and the study linked the findings of the model to the Turkish case and pinpointed a lot of very relevant policy implications. On the comments on the organizational side, and the working paper version I have, the narrative regarding the Turkish case is spread across various sections in the paper. So it somehow confuses the reader. For example, in the conclusion, you mentioned that the Turkish financial market has a lot of foreign investors, so that's why the effect is high on the financial variables. So it's better if you have like a separate section that highlights all the cases of the Turkish markets, either financial, macro, the linkages with the Fed and the ECB, so that it like paved the way for the reader to expect the findings. On the analytical side, I know you overcome these in the presentation, but in the ERF work, in the working paper version sent, there was no theoretical rationale for the monetary policy spillovers. You didn't explain for the reader why there are monetary policy spillovers, why they take different effects. And even the channels, you mentioned this here in the presentation, but in the paper it was not there. Because sometimes the reader is not aware of what's QE, what's unconventional policy, why it affects the emerging markets. So it's important to establish all the theoretical part in advance for the reader. On the empirical model, I think you need to highlight a lot more of the details regarding most of the empirical strategy. For example, for the Bayesian VAR, you didn't mention the equation. You didn't mention why you choose, you picked those variables, their definitions. For example, you could have used, for example, T-bills rate as one of the financial variables for Turkey, especially because short-term rates are usually more effective of the Fed and ECB moves. You could have, for example, a variable for equity movements that reflect the changes in the stock market post the changes in monetary policy by the Fed and ECB. So you better have a section that highlight the different variables, why you picked those variables, and why you left the others. Also, you have mentioned in the paper that you have been using a lot of updated, up-to-date techniques like the high-frequency methodology to identify monetary policy surprises. I know you mentioned that you cited it from one of the references. However, it did not explain for the reader what high-frequency methodology exactly did you use. Also, you need further explanation about how would you identify various dimensions of monetary policy. There is a data set, but the reader does not know how you decided this is QE and this is forward guidance, or from where did you get it. So I believe you have all the information, and you know that maybe you were just like in a hurry while writing the paper, so a lot of details needs to be explained in further details. Maybe also for the empirical model, it would be nice if you added the various decomposition for the variables, because this will show how each of these variables that you tackled affected by the Fed and the ECB rate versus other factors that might have not been incorporated in the model. And that's it for me. Thank you.
Thank you for both. Now we have like 4 minutes for the last paper. So this is the monetary policy and informality. Understanding policy transmission in Tunisia from a heterogeneous agents model for Mohamed Safouane. Mohamed, you're here.
Greetings, everyone. Today I will be presenting our paper, Monetary Policy and Informality, Understanding Policy Transmission in Tunisia from a Heterogeneous Agent Model. So, the last few years were shaped by a worldwide surge in inflation, which prompted many central banks to raise their policy rates. This catapulted monetary policy analysis to the forefront of macroeconomic research, with a special focus dedicated to its distributional effects. So, monetary policy by itself is a systemic action, which is mostly based on the evaluation of macroeconomic aggregates, but it can also, it affects a wide selection of economic agents. Thus, it can generate asymmetric outcomes. So, these works were conducted for advanced economies, which make their adoption for emerging markets and developing economies questioned. One aspect that is always missing is the presence of a sizable informal sector. So informality in our paper is defined by economic activities that are hidden from authorities, mainly to avoid taxation. So how can informality affect the transmission of monetary policy? So on the one hand, informal labor is a source of employment insecurity and income shocks, which amplify monetary policy shocks transmission. And on the other, it has been shown that the informal sector can act as a buffer against these shocks. So in our paper, we investigate this effect. So to our knowledge, we are the first to tackle this topic. So in a first step, we compare some models. Our main model is a small one-asset heterogeneous agent new Keynesian model or Hank model with an informal sector. So the first significant feature of this model is that it drops the classic representative agent model and instead adopts a more realistic heterogeneous aged perspective. So households are differentiated by their wealth and productivity and can be classified into formal, informal, and unemployed workers. The second significant feature is that we allow for a dual sector structure, meaning we have two types of firms and two types of two labor markets. So we complement our work with the three alternative cases. So here we plot the impulse response function to a similar monetary policy shock, and we find that our dual sector Hank model generates less loss in GDP and consumption. In fact, this is the buffering effect in action, but on the other hand, it generates more efficient transmission to inflation, meaning lower inflation. So the second experiment we conducted is that we compared the transmission at different informal sector sizes. So again, we can see the buffering effect increase with the size of the informal sector, especially for consumption, but we also find that it reduces transmission to inflation. Now, we compute the marginal propensity to consume by worker type and the informal sector size, and we find that a gap is generated, is created at high informality levels between formal and informal workers, which does indeed showcase that there is a risk, unemployment risk between these two types of workers. Now, we build on these results and develop a medium-sized informal Hank model. This time, we include an additional feature. Now, informality doesn't affect every household equally, and in fact, there is evidence that the share of informal consumption to the total consumption of households is negative. And this relationship is incorporated in the informal angle curve, which will be estimated and we will be incorporating in our model. So we use the 2021 Tunisian National Survey on Budget Consumption and Living Standards. This survey contains detailed data on consumption behavior of households, including the place of purchase of each item. So the place of purchase is then mapped into two types of stores, modern and traditional. So the modern type store are in general bigger in size, and they are subject to regulatory inspection. Thus, they are less likely to engage in informal activities. So when we compute the data for each household, we find a mean of the share of informal budget of 35.6%. Then we use this data to estimate the following regression to obtain the IEC, or the informal angle curve slope, which we find negative at, which we find is statistically significant number at minus 7.3. So to incorporate this, the IEC in our model, we just separate the formal and informal consumption in the utility function. We also add some additional features like separating wealth into capital and bonds, and add some capital adjustment friction and other shocks. So we use 7 macroeconomic variables from the Tunisian economy from 2015 to 2022 to estimate our model. The model, some parameters are calibrated based on new standard literature and some data averages. some notable values are the informal share of the share of informal sector to GDP, which we set at 35%, and the share of informal labor, which we set at 44%. So these are the estimated and simulated IEC curves at steady state. As you can see, these are not perfectly aligned, but our methodology managed to replicate somehow the IEC. For estimation, we first solve the model numerically. Then we, since the models are developed in continuous time, we compute the exact discrete time representation, then use the Metropolis Hastings algorithm to sample the posterior distribution for 9 parameters and 7 shock standard deviation. Here we have the, again, the impulse response function of economic aggregates for a positive 1 standard deviation monetary policy shock. We find that output drops by 0.29%, and we can see again that the informal sector output drops way less than the formal sector output. For inflation, we find that it drops by 0.19%, and this time again we find that informal sector inflation drops more than formal sector inflation, bringing down the CPI inflation in total. We find that the size of the informal sector increases by 0.3% as share to GDP. So for consumption, we find a particular response. So at first, we have an increase in consumption for all types of workers and at different wealth level. This is especially due to the fiscal policy we set in our model, where the increase in the demand for bonds is channeled for government transfers. So finally, we have the reaction of the wealth distribution. So this is the reaction to a much larger policy shock, but we have the distribution in general shifts to the left, meaning on aggregate less wealth for households, and the effect is especially noticed for unemployed and informal workers and at lower wealth levels. In conclusion, these results showcase the importance of informality for the transmission of monetary policy. Central banks seeking price stability objectives should take these results, these findings, into consideration for effective monetary policy conduct. Now, the buffering effect of the informal sector mitigates aggregate losses in GDP and consumption, but it is coupled with better impact on CPI inflation. This result can justify the active use of interest rates. However, this shock leads to an increase in the size of the informal sector and a decrease in household wealth, especially for lower income households and for unemployed and informal workers. These results add additional complexity to the central bank's objective function, but can be alleviated by coordinating with the fiscal authorities. Thank you.
And I would like in the beginning to thank the authors for this timely and ambitious paper, which addresses a highly relevant and underexplored gap, namely the interaction between monetary policy and informality in developing economies using a Hank framework. So my comments today, I will first highlight the strengths of your work and then offer constructive suggestions aimed at enhancing the impact of the paper. فالمفروض بس مش مشكلة أنا عشان كده كده. So in brief, I will tell you the strengths because we need more time for the constructive suggestions. So I really appreciate the innovative framework you adopted. Combining household heterogeneity with informality is brilliant. It allows us to see who actually bears the cost of monetary decisions, not just the aggregate effects. This is something that traditional rank, the representative agent model, simply cannot capture. I also found the way you grounded the model in real Tunisian survey data to estimate the informal angle curve really impressive. This gives the paper an important empirical anchor, moving beyond theory into something tangible and policy relevant. The policy implications are immediately useful, and finally the technical rigor deserves recognition. The use of a continuous time Hank framework and Bayesian estimation reflects a higher level of sophistication in handling heterogeneity. This is, I know, this is my first time to deal with a Hank methodology, and as you said, it's rarely used, and it requires a lot of effort, and many calculations, and very rich data. So that said, I would now like to situate this work within the broader strands of the literature before suggesting a few ideas. I have 8 main points, but I will share just now 4 of them, and I will share with you the written comments for you if you like to take them into consideration. For the literature review, for instance, I think currently the literature review touches on important strands, monetary transmission, Hank models, informality, but feels somewhat scattered. The key studies like Oklert and Basha's 2023 are cited but not fully connected to each other or to the model's architecture. Ideally, the review should, I think you should review, mention in the literature review how the Ocklert's insight about the MPC heterogeneity and Basha's finding on informal consumption behavior jointly motivate the dual consumption heterogeneous agent structure of the model. So right now, the reader has to infer this connection instead of it being clearly stated. Also, there is no smooth transition from summarizing prior work to justifying the paper's specific modeling innovations. A strong review should show how these existing Hang models omit informality, informal sector models omit heterogeneity. So the paper bridges these literatures by building a Hang model with dual formal informal goods calibrated to Tunisians' informal anger curve. Because, and this will be reflected in the value added of the paper. You said we are the first, as far as you know, to the best of your knowledge, to do this issue. Which issue? Is it this combination of heterogeneous informality or applying this to Tunisia? You need to make it clear because I think you have 2 value added. It's not one. Also, the literature review remains largely descriptive. It would be stronger if it identified gaps, for example, the lack of attention in Oklert 2019 and others to dual labor markets or of the informal sector. Also engaging with IMF or World Bank work on structural policies for developing economies would enrich the framing of the paper. And then the clearer statement of value added, as I told you, you need to make it clear because the work actually needs very explicit and clear value added statement. I have some suggestions that I will share with you. Finally, the literature review shows informality can sometimes amplify crisis, not just buffer, especially when liquidity dries up. Important for Tunisia to highly cash-reliant informal sector. So I think you missed these debates. The debate about informality can sometimes amplify while you said that it buffers the economy. Hank models may also understate wealth mobility, which could matter for long-term monetary transmission among informal workers facing poverty. This is Bayer colleagues in 2024. So maybe you need to add one small paragraph to show that these are the current debates in the literature. For the methodology and model structure, I start with the model structure. One area that could be enhanced is the treatment of informality. The model currently assumes informality is exogenous. But in Tunisia's context, as well as in Egypt, for instance, workers actively transition between formal and informal sectors depending on the shocks or policies. So incorporating endogenous sectoral choice, perhaps drawing on Bosch and Esteban Pretel work, would make the framework more realistic and could reveal important policy spillovers. Similarly, while the model captures household heterogeneity, it might not fully reflect Tunisia's sharp wealth disparities. You have high Gini coefficient. I know that it's not the Gini coefficient of wealth, but it's indicative. So introducing more granular wealth tiers or debt constraints, as done by Byron and others, could sharpen the redistribution effects and reveal more dramatic consumption responses, particularly among indebted households. On informality measurement, the classification based on store type is understandable, but it risks missing substantial parts of informal activity, especially in services and cash transactions. Cross-validating the informal angle curve using cash usage statistics or survey data would strengthen the empirical robustness. I'm not sure whether this is available in Tunisia and whether available meaning available for public use, but this is one important aspect. Also, the model does not yet account for informal credit channels, an important feature in emerging markets, especially for informal workers. They don't have access to the formal credit channels, and they may be subject to very high interest rate in the usury types of loans. I will skip some of the technical clarifications that are needed and data calibration. Let me go to the results and interpretation. The impulse response functions behaves as expected, and the analysis of distributional impact is variable. However, the interpretation could go deeper, especially that in some figures we were discussing here, we cannot distinguish visually between the formal and informal. The two lines, yes, they overlap. So, for instance, unpacking the mechanisms behind the rise and then fall pattern in consumption after a monetary shock would enrich the reader's understanding. Linking the findings more explicitly to practical challenges faced by central banks operating in high informality environments would also enhance the policy relevance. Related to policy implications, while the paper notes important redistributive effects, it could go a step further in offering concrete policy recommendations. You have your policy implications are very too general, and you refer to shock. Which type of shock? And you say they need to be more attentive or something like that. Doing what? So I think you need just to be more specific about the recommendations. For example, simulating targeted cash transfers to informal workers during tightening episodes, or proposing sectoral credit programs to protect informal firms. This could make the paper even more actionable for policymakers. To conclude, this paper presents a highly promising contribution, technically rigorous, substantively significant and timely, by enhancing the economic intuition behind the model, bolstering empirical robustness, and expanding policy recommendations. The authors can significantly amplify its impact in both academic and policy-making circles. So I encourage you to continue refining this work, as it holds substantial potential to inform and influence monetary policy in economies with prominent informal sectors, and I would be more than happy to co-author with you one using the same methodology, comparing the two countries together, Egypt and Tunisia. This will be, I think, very interesting. So thank you for bringing to my attention one new methodology that unfortunately I have not read about before, and for you, your dedication for this kind of it's very much demanding in effort, time, and learning. And as you said, these toolboxes that you have found helped you a lot, and that's how we have to cooperate together to improve our research skills together. Thank you very much for this interesting paper, and good luck. Bye. So these were the 3 papers. We're done. Thank you very much. Thank you. There are questions. Do you want us to take the questions from the... Okay, we have still some time.
Okay, there is a question regarding the paper pricing behavior and exchange rate, evidence from Iranian CPI. Okay, from Soraya. She said, thank you for clear and structured presentation. Your study offers valuable insight into the interaction between exchange rate shocks and pricing behavior, particularly in the Iranian context. To deepen the discussion, I'd like to raise 2 specific questions. First, in your empirical framework, you test the effect of exchange rate shocks on pricing behavior, mainly through the cost shock and of expectation channel. Could you discuss how the presence of menu cost or state-dependent pricing models might alter your conclusion, particularly in the Iranian context where inflation expectations might be volatile? Second, you find that the frequency of price changes reacts more strongly to FX depreciation in the long run than in the short run. What challenges does this pose for inflation targeting frameworks, especially in economies facing persistent exchange rate volatility like Iran? How would you advise monetary authorities to respond? Thank you.
So this is on the... Do you still have Hamid?
Yes.
Hamid? So, Hamid, do you have an answer for these questions?
Do you hear my sound?
Yes, we can.
Do you hear me? Thank you for your comments and a comment in Q&A section. About the first section of question, in menu cost model, we assume the steady state condition that all nominal variables like inflation, exchange rate, expected inflation has the same information. In menu cost model, we don't have multiple common shock. We have one common shock, and originally the inflation and expected inflation are the same. And this literature don't consider the situation that there is a difference between expected inflation and current inflation. Alvarez et al. 2019 mentioned this point and tell that the rising inflation condition or disinflation condition, that the current inflation and expected inflation are differs, may be considered in future works, and the common papers in this literature don't mention this point. Our result develop a road for development of menu cost models in situation that the macroeconomics variables have different informations and conditions. For the second section of the comment, our result can show a strength of inflation targeting framework because we observe that the effect of exchange rate fluctuations on pricing behavior is under uncertainty periods and high inflation. Then if we can control the inflation by inflation targeting framework, the effect of FX fluctuations on pricing behavior will be ignorable and it helps to price stability.
Thank you, Hamid. Anyone here wants to add something to respond to any of the comments? No? Okay, thank you. So this session is done, and let's move to the next session. Yeah. Thank you very much.
Thank you.